What's up, everyone? This is Dave Meyer with BiggerPockets, and I have big news today. This coming Monday, April 11th, BiggerPockets is launching a brand new podcast and YouTube channel called On the Market. And I am going to be the host, and if you're familiar with my Friday content, you're going to be very excited about this because On the Market is all about giving you the news, the data, and the trends that impact real estate investors. And each week, it's not just going to be me. I'm going to be joined by an incredible panel. We have Henry Washington, Jamil Damji, James Dainard, and Kathy Fettke, all going to be bringing their own diverse opinions and experiences to the show to help break down the news and information you need to know about so you can invest with confidence. So for today's video, what we have for you is a sneak peek of what On the Market is going to be every single week. We've been recording some test episodes over the last couple of weeks, and we've put together some of our favorite clips for you to check out today. And if you like it, which I am confident you are going to, you should check out our launch on Monday, April 11th. If you have any thoughts about On the Market or just want to interact with me, you can do so in the comments below or hit me up on Instagram where I'm at The Data Deli. Thank you guys so much for watching. And again, make sure to check out the On the Market launch Monday, April 11th. Thanks.
Rising interest rates, which is a situation that we're seeing right now, has sometimes, not every time, has sometimes had negative impact on housing prices. And so we know the Fed just raised interest rates for the first time since 2018, and they've indicated that they're going to be pretty aggressive in raising interest rates. And, you know, mortgage rates aren't perfectly correlated with what the Fed does, but we are likely in a situation where mortgage rates are going to continue rising at least through the end of the year. So what impact do you see this rising mortgage rate environment having on housing prices? Because you said you're still bullish. Why? How do you square that?
Sure. Well, the Fed is doing what it needs to do and should have done a long time ago. There was far too much stimulus. They went too far overboard. I think most people can agree with money printing and zero interest rates. That was needed in 2020 when nobody was allowed to work. It wasn't needed afterwards. And trillions and trillions and trillions of dollars were created globally, not just in the US. There's a whole lot of money floating around, and, they try to blame all these other reasons for inflation, but it's because of that. Let's just face it. There's a lot of money chasing deals. So what the Fed is doing now in raising interest rates would be the equivalent to mom coming in and taking the punch bowl away and saying, you guys are drunk enough. We're going to take it away. Nobody likes that person and nobody wants that to happen, but it's necessary. So what's happening is good and healthy for the housing market. Young people should be able to afford to buy a house, and prices should not continue to rise at 50% per year. It's impossible. So it's a good thing. It just means that the party's over for some people, and the Fed will get what it wants. It will slow things down, and that is the message that needs to get out there for anyone new coming into this industry thinking, oh my gosh, double digit appreciation, I want in, and then they buy just when things start to slow down. It doesn't mean don't buy. It's just a different game. We're entering into changing times. I had talked about this in a presentation I did recently about changing tides. And for anyone who does any kind of water sports, specifically surfing, I'll speak to that. You always have to check the tides before you go out. Because if you go out when the tide is going out and you're not aware and you surf, you might surf into a rock because all of a sudden the rocks are exposed. And if it's too high, there can be, you try to, in my case, sometimes it's such a high tide, I actually can't get to shore because the beach is gone. It's just water to the cliff. So you got to know what you're doing and what the game is so that you're prepared and have the proper strategy.
Jamil, I saw you getting enthused when Kathy was talking about historical interest rates and sort of where we are in the context of what interest rates used to be and where we are now. So are you concerned about rising interest rates, or what is your advice to people who may have that concern?
Honestly, at this point right now, I think rising interest rates is really just not taking the punch bowl away, but we're just giving the drunk people water. That's where we are right now. right? It's still a party. The music is still playing, right? People are still having a good time. But here's some water, just have some water. And I think that's where we're at. We're at this point where we're leveling off. We're just like, you know what? We know it's going to be time to go home soon. We don't want to be, a total mess tomorrow. Why don't we get some water in us here? Just like Kathy's doing right now. Why don't we get some water in us right now just to kind of level things out? I got to work in the morning. And I think that's where I see it going, because we are still talking about record low rates. And even with aggressive monetary policy and the Fed raising interest rates, I still believe that they're not going to spike to a level that's going to curb buying. I feel like there's still a lot of money out there. There's a lot of demand out there, and we've got so many other little factors, right? We've got these logistical issues. When you've got rising rates and people are feeling the pinch, they're exiting the market. You've got an entirely different beast in the market right now with the secondary home buyers, the investors, the iBuyers, all of that activity. There is so much of it, and we haven't seen that before. And because we haven't seen that before, it's very difficult for the crystal ballers to say, this is how it's going to be, because this is how it's always been. Different game, guys. We got a new player. And, just like when you watch, WWE wrestling, when you got the big guy, the new big guy's in town and nobody knows who he is, like he's going to change everything. That's typically what's happened, right? We've got these hedge funds. We've got this institutional money that is creating a completely different set of factors. So my thoughts are, let's just keep drinking water. Let's have let's enjoy the rest of the night. But there's no point in us thinking that it's going to be, lights out.
Party's not over.
No.
Well, just to play devil's advocate, I can at least see a scenario where in the next 2 or 3 years where prices flatten or perhaps even decline a little bit. And I'm not talking about a crash or 10%. I do think could be a period where if the Fed raises rates so that it tapers off demand and we start to see a reduction in demand, we could see that. But at the same time, at least personally, I still want to buy right now, because even at a 4 and a 4.5% interest rate, which is higher than it was a year ago, that's true. I don't think we're going down to 3% interest rates anytime in the near future. And I would happily ride out a short-term dip in my home price to lock in a 4 or 4.5% interest rate over the next 15, 20, or even 30 years, because even a slight difference in interest rates over that time, you're going to pay way, way less interest. And as long as you're cash flowing, having your home prices go down temporarily is only a paper loss. You're not really actually losing any money. It's just on paper, it looks like you are, but as long as you don't sell at the bottom, you can still do pretty well.